Good afternoon. Thank you all very much for coming to this discussion on the results of the G20 summit in London. I'm Merit Janow, the director of the IEP concentration, and this is an event both that has been organized by IEP and the APEC Study Center. As you may know, the G20 summit in November was the first summit of the G20 leaders. The G20 group had been set up initially as a meeting of finance ministers and central bank heads in the aftermath of the Asia crisis in the late 90s. But after some years and in light of the current crises, it was elevated in November to a heads of state summit with a group of leaders, of which really 19 jurisdictions, representing by some measures 85% of world GDP. So a very important group and an expanded group from the traditional meeting of the G7, G8, thought to be much more representative of the important economies and leaders of the world. So there was a lot of expectations during this current financial crisis of what needed to be achieved and what could be achieved, and many different regional perspectives involved. We'll have a chance to hear about some of the fault line issues going into the summit, but as the coverage amplified before the summit, there were clearly significant differences of views of necessary points of emphasis in this period of crisis, be it on fiscal stimulus identified with the United States predominantly, or on regulatory reform issues often identified with the European community. And you saw some new voices speaking up. We don't have anyone here speaking about China, regrettably, because Professor Wei and Rosen were both unable to join us. But both of them have been speaking in the press and elsewhere about some of the important features associated with China's views at this juncture. And I'm sure that all of you have noticed the rather unusual development, which was the governor of China's central bank offering some ideas in advance of this summit, emphasizing the need for an enhanced role for SDRs, so you don't have to rely too much on any single currency, which is a pretty veiled commentary about concern about the safety of the U.S. dollar has been mentioned. Professor Wei has also shared with me that he would expect that the Chinese would be concerned about a more formal voting right role for China in the IMF. Professor Rosen shared with me a thought he wanted me to share with you, which was that this summit had produced the most serious thinking about the kind of rules of the international financial system that China wanted associated with its position, and it was shifting from really from a system taker to a system shaper going forward. So China's role, which we may not talk about too much with this distinguished group, is something that you should also keep in mind. There's an important reflection of the summary of the G20 results in the communique itself, and you'll see in that a lot of numbers amounting by some counts to an additional $1 trillion in additional resources for the world economy. So we have with us our very distinguished faculty to emphasize and talk about, for only 10 minutes each to get us started, regional perspectives on this G20 summit and its results and the importance for the U.S. and the global economy. You have their bios, so I will not, and most of you have or will or should take courses from everyone up here. So I won't go in any detail in background of our distinguished colleagues, but just to mention Professor Clarida has a career that has spanned senior positions in government, in, of course, our own Faculty of Economics, and also in markets. Professor OHalloran has broad-ranging work on political economy, including recently on the banking crisis and on trade and other matters. Professor Calvo is often called the Dean of Latin American Economists and has served as chief economist of the IADB, senior advisor of the IMF, and a great scholar. Professor Desai is a great scholar of the Russian economy and a Center for Transition Economies director, and our own Professor Harriman, Professor of Comparative Economic Systems. She has written a book on Russia that was identified by the FT as one of the best books of 2008, which I think is a wonderful accomplishment. And Professor Panagariya is a great expert on trade and on the Indian economy. And we're very, very fortunate to have all of them to give their views together. I think we're the envy of New York City, if not Washington. So with that, let me first invite Professor OHalloran to get us started by offering some political economy perspectives on the United States.
Right, and as a political economy, I usually can't talk without PowerPoint, and but so I have my PowerPoint here. I will make them available, Merritt, and if you want to post them on the web or make them available to the students, that would be wonderful. And my role here was really to give you an overview of the major trends that have been going on and to give a backdrop in which the summit was taking place. And as Professor Janow said, that in fact the G-20 meeting in London was really the follow-up to the emergency meeting in Washington in response to the financial crisis in fall. And if you look at every single chart and every single indicator, and I have one here that actually puts every single thing on together, and what it shows is everything tanking. If you ever wanted to see a case where you had a shock, a structural adjustment shock to the system, this is it. Every single indicator just falls right off the cliff. 40% reduction in trade, huge declines in GDP growth. Every other indicator of, you could possibly imagine takes place. And what that indicates is that we're in a time of huge structural adjustment. And you see that this is very broad-based, not only just looking at the large aggregate indicators, but if you look at all of the countries as you break them down, if you across the board, you see there's a huge contraction of economic activity and in things such as new orders and buildup of inventories. And this is occurring in the advanced industrial states, probably most pronounced, but the developing countries, the emerging markets, are close behind. In addition, you can see just global industrial production and trade, again, tanking at enormous levels. And then just a significant reduction in global production, of which we have to understand, with globalization, trade has become an increasing part of countries' GDP. And so when countries, their exports decline by 40%, that constitutes an enormous amount of reduction in GDP. For example, with Germany, its decline in trade constituted something like 14% of the reduction in GDP that it faced. So that's an enormous amount of impact that the global economy is having on the individual's economies. And again, we can just see that just on U.S. imports and exports, they're all declining. And that would have the impact down to issues of resource utilization. And we can see that both in capital utilization and in manpower utilization. All of these are having dramatic declines within the U.S., and consequently they'll be declining globally. And again, right now, these aggregate indicators are most pronounced within the developed countries, but are spreading off to developing countries. And we can see this in China, and this is a country that I did pull out because these trends are enormously pronounced in China. You have, again, a 40% decline of its exports. And I had an interview at Sina.com just on Friday with the Chinese ministers, finance ministers on the opposite side, and he said that something like 75% of the Chinese economy is in some way associated with exports. And so if you have a 40% decline in that component, a very large component of your economic activity, the consequences are going to be enormous. Okay, and you see this it's not only with the U.S., but if you break it down into regional areas, it's taking place, and you can also see this when you look at some of their most highly exported areas, such as in electrical products and mechanical equipment. Consequently, as we've seen, and this is something that the U.S. has faced, is that there's been an enormous amount of backlash to this, and we've seen this in some of the issues rising with Mexico, where they're looking to increase levies by about 10 to 45% on some 90 U.S. goods. China has actually lodged a WTO complaint, or I guess is in the process of lodging a WTO complaint against the U.S. on its chicken meat. And you're seeing a growing number of subsidies taking place worldwide in key sectors such as the auto industry, and there are real questions as to whether we start hitting up against issues of countervailing duties that may occur and other unfair trade practices that may be subsequently lodged. Now, within this backdrop, we then have the G-20 meetings taking place. And from the U.S. perspective, the primary purpose was really to build confidence, to demonstrate that the United States had a stimulus plan to impact the economy positively and address the U.S. financial crisis head-on. In addition, they needed to show a commitment to global cooperation. We've seen the cooperation perhaps most readily on the coordination of monetary policy from the central banks, but they also wanted to seek broader cooperation on fiscal policy as well. And again, revisiting some of the financial regulation issues and rethinking the global rules of risk management that are embodied in the Basel II Accords, which for the most part are pretty much defunct right now. So this is a prime opportunity for emerging markets and large participants in the world economy, such as China, Brazil, and India, to take an active role in reshaping what many of those rules have been. In addition, the third component was to strengthen international organizations like the International Monetary Fund and the World Bank. And this is going to be a key means by which to mitigate the impact of the global recession on developing and emerging markets. So what were the major successes? As Professor Janow said, we had this large infusion or commitment of funds, and we'll see if they materialize, right, of about $1.1 trillion. And it's predominantly to recapitalize the International Monetary Fund, including about $250 million in special drawing rights, $250 billion. The numbers the zeros get so many at a certain point you lose it, right? Millions sounded a lot not too long ago, but now we're up to billions. $250 billion in credits to fund international trade, which is actually a very important component, because when you looked again at all those trade indicators, the huge and steep decline of trade really had to do a lot with the lack of funding of it, or lack of loans to facilitate it, and the additional $100 billion of loans to developing and emerging markets. So the other component was a political component, that in fact there would be discussions with China, India, and Brazil to have additional voting rights within these multilateral organizations, of which they are becoming an increasingly large component of the global economy. And then they created a financial stability board, which is actually, we have these things already, which is really just the reincarnation of the Financial Stability Forum, right? And it's served as to monitor systemic risk internationally. In addition, it previously had set rules and standards that were adopted in a variety of different contexts. So it was sort of little known. It did have some coordinating and harmonizing powers, and now it's giving a beefed up name and role to play in stabilizing or monitoring. If you want to think of a risk police or something along those lines. We won't want to call it a global regulator. That's too cosmic, but somebody, sort of a cop who's going to look for places where there are critical stresses in the system that need to be monitored and adjusted, and perhaps increase in leverage, liquidity, and so on. So what are the implications of the U.S. market? Well, there's continued coordination on the monetary policy, and we saw this in Monday's currency swap agreement between the central banks, which is again a liquidity facility that I think is very, very important in making sure the credit markets functions. You can get loans, the banks can get loans, and so on. Maintaining global trade is absolutely crucial for a successful recovery and to mitigate the impacts on the poorest countries, and I think that commitment is important. However, the World Bank did state that after the G20 meeting, 17 of the G20 countries imposed restrictive trade policies. So we'll have to see to what extent that can be maintained, especially in light of increased domestic pressures to save jobs and to mitigate the recessionary impacts of this global fallout. And again, supporting emerging markets has been one of the key areas of growth that we've had in the last decade, and I think bringing on those huge number of consumers into the world market is absolutely imperative. And I'm down to 1 minute. So in all of these cases, we have seen some initial signs of recovery, both in the credit markets, where these indicators, the TED spreads and all these LIBORs are gone down to normal rates, which is actually good. Mortgage rates have fallen down below 5%, so in the U.S. that's all good. And you've also seen a slight uptick in orders and different types of surveys that are taking place in the manufacturing. So to the extent that this is sustainable, we shall see. To the extent that the G20 commitments to global sort of cooperation and making sure that there's sufficient liquidity for both developing and emerging markets to ride out the recession, I think will be key. And the way in which we can harmonize both the fiscal and monetary policies, I think will be very important going forward. And trade, I believe, is going to be the key.
Thank you very much. Professor Calvo, would you care to speak on Latin America?
I thought Rich was before me.
No, I think we're going to have a U.S. perspective at the beginning and at the end.
The sandwich.
Sandwich. That's the word I was
And the rest of the world is in between. Huh?
Sandwich this discussion.
Okay.
You are the meat.
We'll see. Okay, well, thank you very much, Merit, for inviting me and being part of this exciting panel. I'm supposed to speak from the perspective of Latin America, but let me say something a little bit more general about emerging markets. I think the big news here is that the change of views or vision that the leaders of the world represented in the G20 have about how to deal with this type of crisis. In the past, in 1995, for example, we had the tequila crisis in Mexico, and the standard way that the crisis was treated and combated by the standard means at the time, which was you went to the country, saw what the problem was about, and after some number of months, you would agree with the country on an adjustment program. This was a very ambitious adjustment program, unprecedented in terms of numbers. It was a 50 billion program that was coordinated by the IMF, and the U.S. contributed with about 50% of the total. So there was a lot of very good will on the part of the international community. However, output in Mexico fell by more than 6%. The policies that were implemented were pro-cyclical, not anti-cyclical. And that was the standard for the time. And once again, this was a really outstanding program in terms of the goodwill of the international community by the numbers that were involved, and also the recovery took place within a year. Compare that, 50 billion, with what happened the other day. Mexico applied for a $47 billion in this new facility, the FCL, flexible credit lines, that was enacted recently by the fund. Mexico is the first one. And what's interesting is that the numbers are comparable. But Mexico is now having access to these sums, very substantial sums, even though they are very far from having a balanced payment crisis. So the change is fundamental here. The international community seems to have finally understood that these crises have a financial nature, and in order to attack them successfully with a minimum of cost, you have to move preemptively. So it's like a central bank. That's the idea of a central bank. So we are sort of groping towards a global lender of last resort. Now, where the funds are automatic, preemptive, and large. Now, the problem here that I see, so that, before talking about the problems, I think that's excellent, very good news. Now, when you start looking at the details, now let me say a few words about Latin America, then the numbers don't look that large. Now the fund can lend about $750 billion, which is a very big increase from where they started. However, we had a presentation this morning about Latin America. The IDB has just computed some numbers on possible needs without going to extremely bad cases, bad scenarios. Well, just amortizations for the region in the next 2 years would amount to more than $400 billion. Now, if you have a sudden stop, amortization is a big issue. You may not be able to reschedule that. Once a country has problems servicing the debt, all kinds of other difficulties pop up. So I'm not saying that that's going to happen, but we see already that there is a big retrenchment in capital flows for emerging markets. For example, in 2007, we were talking about $1 trillion, and according to the last estimates by the IMF, they expect that in 2009 it will go down to $160 billion. So a very large decline in capital flows to emerging markets. Why this is happening is I don't have time to elaborate. So, but let me give you some my perspective about this. Despite the fact then that we have this very good news and a change in the attitude and the understanding in thinking about these processes, and again, I'd like to emphasize this is very, very important because it's just the beginning. So maybe I wouldn't be surprised if the G20 keep going forward if necessary, with more funding, with more ideas. Now, I'm a little concerned that the lender of last resort, ideally, it's like a central bank, should be able to print money or to give credit freely as much as necessary in order to stop a crisis from developing, a purely financial crisis from development. Given these numbers, I hope this doesn't materialize, but you cannot discount the possibility that the funds will not be sufficient, especially if several countries come to the fund at the same time, which is not unlikely given the situation in Eastern Europe. Now, Latin America is in good shape, but still there is this problem of amortizations. So I think the next step should be to think, once again, go over the so-called Keynes proposal, which was to let the IMF operate more like a regular central bank, in which case, for example, the IMF would be able to print SDRs, to issue SDRs, and without, in principle, any upper bound. But obviously, there would be accountability here, but the accountability would be ex post rather than ex ante. So that's a complicated issue. I'm not saying that it's something that we can get right away, but I think we should be moving in that direction. What worries me a little bit about the G20 communique and some of the discussion that's going on in policy circles is that perhaps because we have the Madoffs of this world that capture the imagination of everybody, no matter whether you understand the deep economic issues involved, there is a tendency to talk a lot about new regulations. And obviously there is a need for new regulations, but I'm afraid that you cannot have an effective financial system working just on the basis of new regulations. It's very complicated. It's very hard to anticipate what the new problems are going to be. So even if you have draconian regulations, there could be ways out or around those regulations. So we, obviously, at the national level, we found it useful to have a central bank, which in situations like this, what it does is to substitute for the lack of the imperfection in the monetary and fiscal financial system by providing services as a lender of last resort. We saw that in action these days in the G7, and you did that even more so for emerging markets. So I'm a little worried that we may end up putting too much emphasis on regulations as opposed to lender of last resort, and my advice would be to try to think both things at the same time. Thank you.
Thank you very much. Professor Desai.
Thank you very much for inviting me. I'm very happy to be part of the distinguished panel. I have a few copies of my letter, which was published in the Financial Times on the eve of the London summit, if you would like to have a copy of that. I want to make 3 points and make an argument that Russia was an odd man out at the summit. But at the same time, there are some indications of Russian policy making which make one hope that the financial crisis which is developing in Russia has a silver lining, and that some positive policy changes may come about. So the 3 points I want to make, take first the stimulus, the American-style stimulus with massive budgetary ballooning deficit, hopefully short period. The Russian position sort of aligned with the Franco-German position. Both these countries' leaders, Angela Merkel and Sarkozy, saying that we would rather settle for a negative growth rate rather than inflation. So we are not in favor of a big stimulus. The Russians sided with it because the Russian inflation was already very high. It is running at the rate of 13% annual right now. The short-term discount rate of the Central Bank of Russia is again 13%. And so this whole policy thrust of the Central Bank of Russia it's engaged in fighting inflation. And so massive credit creation, therefore, would be playing an opposite role. At the same time, the decrunching of the credit crunch again will lower the value of the ruble against the dollar and the euro. So that is also a fear. So far as the stimulus was concerned, the Russian position, therefore, was we are not in favor of a stimulus. Ultimately, of course, we didn't have a big stimulus package, which President Obama would have wanted. The 1.1 trillion announced at the end of the April of the summit was essentially $500 billion more for the IMF funding and $250 billion more of SDR allocations to member countries of the IMF to make more credit available to the member countries. This was essentially the stimulus. Now, on that issue, the SDRs and the IMF increasing the IMF funding capabilities, the Russian position, it sided with the Chinese. And we know, as Professor Janow mentioned earlier, the Chinese position, not only that the IMF should be restructured with increased voting rights for some of the emerging market economies, including China, of course, but that the SDR should be a reserve currency. And the Russian position was similar. If you read the transcript from the Kremlin, from the president's website, it's very interesting at times, the kind of announcements which come from that end, that there should be the unipolar world dominated by the United States, and the dollar should become a multipolar world with more diverse currencies, and then SDR is mentioned. But we know that, of course, that went nowhere so far as the final agreement at the London summit was allowed for, except to suggest that there should be increased funding in the IMF, including 250 billion of SDR funding for member countries. The third point, which I want to make, why Russia was was an odd man out at the summit, was because the Russian financial crisis is very different from the symptoms of the crisis which we are having here at the U.S. end. First of all, after the August Russian-Georgian war, the ruble has crumbled against the dollar and the euro. Foreigners realized that Russia was becoming an unsafe place to invest in. So whoever could sort of get rid of their ruble assets, convert that into rubles, and convert the rubles into dollars and walk out of the country. And so the foreign exchange reserves of the Central Bank of Russia, which were third highest after China and Japan, in mid-July of last year, $600 billion. Currently, they are around, in end of February, number is about $350 billion. So the Central Bank of Russia, therefore, was doling out dollars as foreigners, and even Russian domestic banks converted rubles into dollars as the ruble continued declining against the euro and the dollar. Today, the ruble has more or less stabilized at about 41 rubles to this combined basket of euro dollar, but it was 25 rubles to this combined basket last July. So there is a sharp decline in the value of the ruble, but it seems to have stabilized for now. So that is one symptom of the financial crisis, which we do not have here, in the sense that the dollar is doing reasonably well against the rest of the world currencies. The second feature of the financial crisis in Russia is that during the growth period from 2000 to 2007, when the Russian economy, which was oil and metals led, high prices of these items in world markets, and Russia exporting these items, especially oil and energy, 2000 to 2007, the economy grew at 6.5 to 7% growth rate, real GDP annually. And so the Russian oligarchs who had captured the big assets of the economy during the reforms under Boris Yeltsin in the early 90s went into an expansionary mode. Expand our businesses, the economy is growing. And so they borrowed from Western banks. And then, of course, their stocks declined, started declining. Margin calls came from Western banks, pay up the hard currency loans, which you have had from us. It's the same predicament with the Russian big banks. They also had borrowed. created assets and loans during the expansionary phase, and they also faced repayment problems. Where do you get the dollars from, hard currency from, to repay your foreign creditors? So the Russian, Vladimir Putin, the prime minister, $50 billion were allocated for bailing out the oligarchs and the big banks. Up to 11 billion were doled out, 5 billion to the aluminum oligarch, 2 billion to the nickel oligarch. And so one is looking for, where is Barney Frank? I mean, is there some legislative oversight here? No, it was just done who needs what as the prime minister decided. Okay, so now in mid-February, there was a policy switch. No more bailing out of the oligarchs and of the big banks. And I said, oh my God, there is a policy switch here. You are on your own, guys. You sink or swim, find the dollars on your own, because you have dollars stashed away somewhere, offshore accounts. And you are in cahoot, the oligarchs and the banks, because there is a joint ownership. Find your dollars. No more support from the government-owned bank. And I thought, this is so refreshing. Is the incestuous link between the oligarchs and the Kremlin finally ending? Wouldn't that be nice if, you know, the oligarchs are holding the Kremlin sort of a hostage, and perhaps this is ending? So I'm very cautious about that. And the second thing, policy shift, which has continued, is that the Central Bank of Russia, while the ruble has continued declining, has allowed it to continue falling. There are no explicit exchange controls introduced. And so I hope they stay with this policy. Every morning I wake up and I want to not find that the Central Bank of Russia has introduced explicit exchange controls. It hasn't so far. And so I would say that the financial crisis has a silver lining with regard to policy changes, and it will depend on, you know, whether the technocrats in charge, the central bank governor, whom I have met earlier in his assignment, the finance minister, Alexei Kudrin, who are very fine, first-rate technocrats, and whether the prime minister and the president will continue listening to their policy moves, and how there is so much politics here. I mean, when the link between the Kremlin and the big business in Russia, my time is up, so I cannot tell you a joke, but I'm so I'm hoping that this link is sundered forever. Thank you very much.
Thank you very much. We'll come back to your joke. We can't leave without hearing it. Professor Panagariya.
Thank you, Mary. Thanks for the invitation. Let me just say very briefly first, you know, what the G20 means for India, which is not really very much, actually. And then I come to tell you a little bit about, you know, how the crisis has unfolded in India. I think, you know, from India's perspective, the G20 meet really has much more symbolic meaning than any substantive one. Symbolic being that, you know, here is a country which was so closed, so autarkic, so centrally controlled. It has now opened up, and it's now sitting with the big boys. And that very fact itself, to some degree, helps for the future that, you know, perhaps Indian leadership will act more responsibly down the road and not reverse a lot of the economic reforms that took place in the last 20 years or so. I think this is the major kind of symbolic benefit, I think, to India. Substantively, I think where perhaps it might gain some is the $250 billion that has been allocated to the trade credit, because India's trade, like every other country's, has been badly impacted. And a big part of that problem has been the trade credit. So I think restoration of trade credit, if it does happen, would certainly help to some degree. India also made a big pitch about tightening the rules on tax havens. A little bit of progress there. I don't think it's going to make a big, huge difference. And finally, India has also been pitching for increased quota in the IMF. This is the voting rights in the IMF for the developing countries. And there is some movement in that direction. You know, the next meet for doing the reform, which was initially slated for 2013, is now moved to 2011. So some progress there. So that's mainly my kind of summary of what G20 meet itself means for India. But let me quickly kind of race through what happened in India, you know, how the crisis unfolded and where it stands and how one sees it going forward. So India was growing actually, if I take the 3 years prior to 2008. 2008, India grew at 7.4%, which is quite respectable, quite good actually in the environment. This is the last year. The prior 3 years, India had grown 9.4%, so that's a 2 percentage point decline. Now, that actually looks quite good, but once you separate out what happened in the last quarter, India really got impacted actually soon after the Lehman Brothers demise happened. And then, you know, in the quarter that followed, October to December, last quarter of 2008, growth rate declined to 5.4%. And I think, you know, we don't have the further figures on growth rates, but we have figures on exports, and those are certainly tumbling down. The last we have is February 2009, and exports during that month declined 20%. And, you know, every single month actually following the September demise of Lehman Brothers, actually export growth has been negative. So that's a big kind of concern, and that is going to necessarily feed into the GDP growth decline. Also, India is not as export dependent as China is. India is, you know, about 20-21% of the GDP exports of goods and services. China is easily more than twice of that. So India is less impacted by that. Now, India was also not very much impacted by the toxic assets problem because Indian banks were not invested in those. The regulation was very tough on the Indian banks. 3/4 of the banking assets are in the public sector, and so therefore they were not impacted really almost at all by the toxic assets. What impacted them was the liquidity. The moment the crisis happened on this side, the investors, the lot of foreign institutional investors who had investments in India pulled out, and that created a liquidity shortage. Stock market decline, which led the domestic investors to pull out their money as well, which further kind of tightened up the liquidity. And I think, you know, down the road, the entire investment atmosphere has actually deteriorated, as a result of which the banks have become very jittery. So like here, India faces very much a problem with the liquidity crunch. There's a lot of, you know, the banks have resources, but even, you know, if you look even, you know, the amounts that are now holding with the central bank overnight, and this is called the reverse repo in the Indian terminology, they are holding almost twice as much of their liquidity with the central bank as they were doing in more normal times. So there is certainly a liquidity crunch, and that the central bank is struggling to unfreeze the markets. Gradually, perhaps some progress, but still some ways to go. From the solvency point of view, in a way, now it's the real sector which seems to be actually beginning to impact the banks. You know, there are defaults on the bank loans. So, you know, growth rate has come down, at least as I said, in the last quarter of 2008 to 5.3%, and that has led to some defaults on the loans, and so the non-performing assets actually, you know, in a way, quite in the way that's reverse of how it happened in the U.S. Here the financial markets actually impacted the real economy. In India, it's now beginning to happen in the reverse, that the real economy is suffering, and that in turn actually is creating defaults for the banking system, and that is leading to accumulation of the non-performing assets. And so there are plans, at least the government is reacting, so there are plans to recapitalize the banks coming 2010, 11, 12. So it has actually lined up some loans, about $5 billion worth from the World Bank precisely for that specific purpose. So that should be okay. Going forward, I kind of remain cautiously optimistic. I certainly get classified always among the optimists, perhaps a bit overly optimists as to where to go, what is to come. I mean, I think India will still manage to put out about 5% or so growth rate in 2009. One of the indicators I use is the there's the big success story of the economic reforms in India, which is the telecommunications, and India has been expanding telephones at the rate of about 11 million telephones per month, not per year but per month. It's a very phenomenal kind of expansion, and that you see is continuing actually. In the times, even 10 years ago, the telephones were used to be, tele-density used to be like 2 per 100 population, and now even in the rural areas, actually it has gone to 13, 14 per 100, which means virtually every second household in rural areas has a telephone. So, and that that is one certain indicator which has not slowed down. That expansion is continuing. So, in other ways, I think India is relatively protected, because also on the macro front it is well run. The inflation rate actually, which was at the time when the inflation was very high everywhere, in India also it had gone to about 8, 9, 10%. Actually, at the peak it went to about 11, 12. It went in double digit, which is rather unusual for India. That has now come down to below 1%. So inflation certainly is not a big issue. Also, the foreign exchange reserves have been a big kind of help. India has had accumulated about foreign exchange reserves in excess of about $300 billion. And during this crisis, when money came out, and also partly I think there was an evaluation effect because of the euro holdings went down in value. In dollar terms. So they are now down to about $250 billion. But what that cushion actually provided was that the exchange rate did not depreciate as much as it would have under, even 6 or 7 years ago when the reserves are extremely low. So there was some devaluation, which is okay actually in a time when the exports are suffering. Some depreciation is actually welcome, but it didn't. It was about anywhere, depending on from where you count, about 15 to 20% devaluation of the rupee, which is quite looks quite okay. So I think I sort of remain cautiously optimistic about India, although one has to recognize the fact that what happens here, both in the U.S. and Europe, the big economies, is going to matter. I mean, if the recovery happens here, relative, in a year or two, I think the overall beating India would have taken as a result would not be that bad. If it if the current situation or something close to it continues here, and I'm sure then India will suffer also, which for India is too bad, because India has finally kind of accelerated to about 9% growth rate, and my own view is that if the recovery happens in the rest of the world, India will return to 9%, and this is going to continue for at least a couple of decades. But if the recovery doesn't happen in this part of the world, then I really don't think India can really return to 9% for some years to come. So that's where I would leave. Thank you.
Thank you very much. Professor Clarida.
All right. Well, it's tough to go last after such a distinguished panel to think of anything novel to say. So here's what's on my mind. I'd like to make a couple points. First, about the G20 summit process. I mean, I think it's easy in this day and age, given the focus on the financial crisis, to be cynical and skeptical, and obviously given the decision to hold the the summit in a media capital with 20 leaders and all of their staffs and everything. It was guaranteed to generate daily, if not hourly, stories in the FD and on the blogs about Sarkozy might storm out, or there's a rift between this or that country. But I actually think this process, if you combine the November meeting in Washington and this meeting, is actually quite remarkable. And I think when the history of this period is written in 20 or 30 years with some context, it really will be clear that it was remarkable. First of all, to get any sort of substantive agreement in any sort of a G-level meeting is unusual. And when the stakes are this high, it's especially impressive. And if you combine what has happened both since November and at the April meeting, you'll see along really all four dimensions on policy, regulation, the international financial institutions, and trade, and probably to some extent the least in the trade area, you really have seen some impressive accomplishments. You have fiscal and monetary policies, as Sharyn mentioned, which in any other context would be seen as quite dramatic, both in their scale and scope. On the fiscal side, both discretionary fiscal actions as well as automatic stabilizers. Obviously, monetary easing around the world. I'll talk in a moment about some convergence in thinking on the regulatory end. Probably most of the headlines pertain to the international financial institutions, where you have a substantial doubling or tripling, depending on how you measure it, in their lending capability. And so I think those are all noteworthy accomplishments and really and obviously timely given the crisis. I'd like to say a word about issues of policy, and in particular policy correlation as compared with policy cooperation. We clearly are seeing correlated policy now. Most countries are running very easy monetary policy, cutting interest rates at or close to zero. Many countries, the U.S., the U.K., some others, engaged in so-called quantitative easing. So policies are obviously correlated. They're doing the same thing. Are they cooperating? Well, I think on the monetary end, that's a hard call. These are policies that are in each country's self-interest, and there's a long literature both among economists and political scientists which emphasize that there tends to be sort of a self-reinforcing nature of monetary policy. On the fiscal end is where it gets more interesting, where you really do have some classic free rider problems. Think of the limiting case if you're a small country in Europe and you export a big share of your GDP, and the Germans have a big fiscal expansion. A lot of that will leak out to you, and if you've taken my class, you know that actually happens on fiscal policy. And this is indeed the issue in Europe now, is about these issues of free riding. And so to the extent we've had the fiscal policy actions that we have certainly is, I think, is noteworthy. Where I think we will get real cooperation in the sense of a textbook game theory cooperative outcome, potentially, is in financial regulation. Traditionally, the challenge to getting unified regulation has been that when the U.S. considers proposing tough regulations or tougher regulations according to Wall Street, the pushback from Wall Street is, well, all the business will move to London. And in the UK, if they start talking about doing tighter regulation, the firms say, we'll just move the business to the US. Okay, so I think there's a possibility now that given the magnitude, depth, and severity of this crisis, that you actually will see, at least at some broad level, not at the fine level of detail, you probably will see a cooperative outcome when it comes to the interest rate and credit default swap market. Tim Geithner has said for some time he'd like to move that activity onto exchanges where it can be monitored, where there's less systemic risk. In the past, during the 1990s in the Clinton administration, when there was talk of putting these default swaps under the oversight of the CFTC, the pushback was, well, the business will just move to London. So I think now you may get some broad agreement in that area. Again, it's way too soon to tell, and that really would be, I think, an indication of how this crisis could move in that instance to a cooperative outcome. In terms of what the future holds, I'd say a couple of things. And I would defer to my good friend and expert, Guillermo Calvo, on this. I'm a little bit perhaps more skeptical than he might be on creating an SDR currency issued by the IMF. And let me be more blunt. I'm against it. I'm more than skeptical. I'm against it. But that's what makes for a lively discussion. I view this whole SDR talk by the Chinese perhaps being less informed than my colleagues at the business school on this. I view this talk of the SDR by the Chinese as essentially one element of an engaged bargaining effort that they're engaged in. They obviously want a bigger say, and they deserve a bigger say in these institutions. The SDR is very dear to the IMF. It sort of has been irrelevant for 40 years, and now someone's paying attention. And so that's fine. But in the big scheme of things, and I think an IMF-issued currency is not, in my lifetime, going to become the global reserve currency. Now, that's not to be confused with the action that was taken in London, which is a once-and-for-all increase in SDR allocations, which, in effect, essentially is a way for the rich countries to provide some unconditional lending to poorer countries. It's not a very efficient way to do it because under the IMF's charter, essentially everyone has to be allocated new SDRs in proportion to their capital. They just couldn't hand them out to the poorest countries. But nonetheless, at the margin, it's probably not a bad step in this crisis. But that step should not be equated with the world moving to the SDR, at least in my judgment, anytime soon. So I think I'll stop there. I've got a little bit of time left, but I'll reserve that for what I'm sure will be good questions from the audience. And Padma's joke, too. I want to hear that.
Well, thank you very much. I think on the assumption that we do get a chance to speak with each other, which frankly is not always true, but nevertheless, I think I'll just open it up so we can hear from all of you and what's on your minds. Question there. Please stand up and project.
Hi, my name is Akash. Hi, I just have a quick question about SDRs. I heard several of you mention them. Isn't it the reality that just the special drawing rights are nothing more than a synthetic currency that just promises a mix of euro, yen, pounds, and dollars in the future, and that the whole notion that I think is being implied that we're moving away from the dollar being the reserve currency, even though 70% of reserves are held there, all commodities trade in dollars, all trade is conducted in dollars. Isn't that just a bit ridiculous? And then China, which you can't even convert to the RMB for all Chinese investments, and they're close to their currency. I mean, does this make sense?
Guillermo?
Let me take advantage of that question to clarify something. I was not proposing to use the SDR on a regular basis. I was thinking about this emergency situation and the need to be ahead of the curve. So I'm a little bit concerned that we are behind the curve, that the sums are not, they may look big, but for that purpose they may not be. I just gave you an optimistic estimate by the IDB, but there is a bigger one number that I won't mention here that might be needed, funding that might be needed. So that's my concern. So try to be ahead of it, but I agree fully with Rich. I mean, going to a global lender of last resort, that's a big operation. And I don't know if I want to be there, but I was just replying to that. Now, in terms of the question, yes, it's a fixed exchange rate. So you are just printing money. You are it's like getting the credit card from somebody else, and you have this synthetic money that you produce, but it's fixed exchange rate. So you are given the authority to print other people's money.
Plus, it's interesting, since China is one of the largest U.S. currency holders, that they would want to move to something like that quite rapidly, since clearly that would lead to a devaluation of the dollar. So I think it was, as Rich was stating, a very strategic move.
It was an expression of unhappiness on numerous fronts. Would you like to add further?
No,
to that?
I think.
Okay.
Can I say something?
Oh, please, of course.
Those of you who read Paul Krugman, and I never miss reading Paul, he suggested that, this whole business about the Chinese and the Russian demand for making SDR a reserve currency, in the Chinese case at least, he suggests that if the Chinese had not kept their currency very low with regard to the dollar and other currencies, then they would not have had this problem of this massive accumulation of foreign exchange reserves, and then the whole problem of where to invest them, Federal Reserve bills and bonds. So why didn't you sort of arrange your exchange rate policy appropriately if you were worried about this kind of a predicament. What do you think of that?
I just have a quick comment on that, and obviously that's a very important point. But I'm very persuaded by what I associate with Dooley and Garber and others have made this argument, which is it was an integral part of China's development strategy. They were able to produce more goods than they could consume domestically, and the only way to move those hundreds of millions, potentially tens of millions of people every month towards the modern sector was to export it, because they didn't have the level of domestic demand. So it was their development strategy, which has been, along that dimension, very successful. So it would have been nice had the global economy had another residual source of demand for their output, but Europe was running surpluses and Japan was running surpluses. So it went to the U.S.
Other questions? Yes, please. Questions, Professor?
Use the mic. Where's the mic?
Oh, sorry, the man with the mic. I will call on you next.
Thank you. Elena Birnbaum, a student and an officer at Columbia. Question to Professor Clarida. Your view on inflation expectations in light of monetary easing, and if I may, a twofold. There seems to be, or do you perceive, an inverse relationship between the dollar strength and global economic growth? And would you expect that to decouple and the dollar to remain strong, hopefully when the economic growth resumes and the world recovers?
Yeah, I'll focus on the second one because it's probably a little bit more germane to this panel. Yeah, I think one of the common themes, if we'd had this session a year or two ago, would have been financial crisis, collapse in the dollar, because it's got to be the dollar's fault, so everyone will leave the dollar. And of course, what's happened is we have the worst financial crisis in 75 years, and the dollar's value has been going up. So the dollar remains the safe haven, the flight to quality currency. That's not a theory, that's an fact. So I would expect, fingers crossed, that if we move through 2009 towards a resolution of the crisis, if the contraction in the economy bottoms out and we begin to see growth, then that would be a negative for the dollar. Yes, because whether or not you're looking at economic growth or monetary policy, all the textbook fundamentals, but for the flight to quality, are very dollar negative, and I would expect the dollar to resume its downtrend. And I think I'm hoping I'm right, because that will mean that the economy is recovering. As to inflation, look, Bernanke's made it very clear and said publicly now, he's throwing everything that he's got and more at avoiding deflation. And so clearly he's stacking all the chips on the side of trying to generate inflation. And the very interesting question is, if it's successful, then the Fed is going to have to pursue an exit strategy. And it gets very complicated because the Fed is now making the mortgage market, it's now making auto loans, it's now directly supporting treasury prices. So this is really, you'd have to go back to World War II to see as complex an exit strategy for the Fed. So stay tuned. We'll see.
In the back with the mic.
I have two questions, one for Professor Clarida. We have seen a lot of emphasis... for Professor Clarida. We have seen a lot of emphasis being put on a financial stability forum, while we have other organizations like BIS and IMF. So won't it be a better idea to strengthen those institutions rather than bringing in another organization and giving it a part of a job which should have been given to either BIS or IMF?
A few of our colleagues may have views on that.
Exactly. No, one others.
Please start.
Oh, well, I think in part of what's going on is that the BIS itself is going through a little bit of institutional reflection now, because I'm not an expert on banking, but there are those who are, and they say an unintended consequence of some of the BIS Basel II reforms is that they actually provided incentives to banks to move into off-balance sheet activities, to put over-reliance on ratings. So I think what's going on here is a little institutional competition, which perhaps is not a bad thing, but that would be my perspective.
Professor Panagariya?
Yeah. It may also be that, some of the countries feel that IMF is not an equal institution, that the US and Europeans have many more votes, and so perhaps an alternative where there is a bit more role for some of the other G20 countries. So that certainly is a consideration.
Other questions? Sir, right here in the...
I have a question. How to strengthen the international organization? In my opinion, this financial crisis was caused by a wrong economic policy in the United States, just like too much easing monetary policy, or it's a housing loan policy. The Freddie Mac Fannie Mae offer a housing loan to too dangerous people or person, and also I think also regulation policy is also wrong. To United States cannot regulate a big investment company, just like Lehman Brothers or Morgan Stanley or something. So I think the problem is that nobody could correct or point out wrong economic policy in the United States. So in my opinion, the international organizations should be strengthened to supervise the major G7 countries' economic policy to avoid the next financial crisis. So how do you think about my opinion?
I think it's very doubtful that we'll have a global regulator that will manage the G7 policies at that level, the macroeconomic policies at the level. There will be, I think, as Professor Clarida was suggesting, there is a move towards more coordinated effort on the regulatory front. Moving on the Basel, they had Basel, which was a coordinated policy on the regular front with very deep. I mean, the three pillars of Basel and the way in which was regulated and very deep risk management components to it, a series of financial accounting standards that were being moved to, and other real basics that would provide for transparency. But the Basel is probably deeply flawed, and it was why the United States, one of the reasons why the United States did not implement it was because it was very pro-cyclical. Besides, it was move away from the leverage ratios and towards these very complicated risk assessment management. So my sense is that there will be different types of financial regulatory structures put in place that, again, go back to probably more simple leverage ratios, other types of capital ratios that would be also instilled. And there will be compliance efforts along those ways that will be international in components.
I think one of the failures, certainly there has been failure, and you can do something at the more global level and systemic level. But I think one of the problems with Basel agreement is that it was reached mostly looking at microeconomic issues, not macro issues. So it's a combination of the two that we need to work more and understand better. And in that sense, I agree fully with my colleagues that regulation will be very difficult, and supervision and have any authority on sovereign countries. You see examples all the time that those institutions are unable to do that. So they can express their views, but that's the most they can do. But I think it would be important to put the two things together, because that's where we have failed quite badly, to see that beyond the microeconomic risks, there are these macroeconomic systemic issues, and to put the two things together and to have an institution like the IMF. That's an advantage that I would see in the IMF over other institutions that don't have the same technical structure and tradition.
Hi, this is a question for Professor Desai. The question might be a little off topic, but given the recent changes, the policy changes in Russia, where do you see Russia's sovereign wealth funds, the Reserve Fund and the National Wealth Fund, going in the near future?
Please tell us your joke. Well, the Reserve Funds, I mean, there has been the sovereign funds have been set aside by the Ministry of Finance in a separate account. And there's a lot of discussion going on, where should these funds be allocated? And they're very cautious about it. The finance minister, Alexei Kudrin, would like to invest them in, private stocks, in the corporate sector, anywhere here in the U.S. This was before the crisis in Europe. But then there are also conservative elements which suggest don't get overboard. There should be a limit to how much you invest of these sovereign funds abroad, or in, be careful about overextending over leveraging yourself. So there's a continuing debate on that issue. But I think what I wanted to bring out was that there is a huge debate going on in Russia between the Prime Minister on the one hand, Putin, and Medvedev, who is younger, who is more, both of them are trained lawyers, but Medvedev belongs to a different generation and sort of more in line with the technocrats, so I hear from Russian analysts whom I see, more in line with this cutting the link between the Kremlin and the oligarchs. You cannot continue supporting them forever. On the other hand, the Prime Minister Putin's supporters, they are more the Siloviki, as we call them, from the former KGB types, the interior ministry types, who have ties with the oligarchs. And they are sort of more conservative in that. No, how can you cut off the link? Because some of us will suffer in the process, because we have links with these oligarchs. And so this whole debate then gets into how do the two leaders, how will they work together? Will the technocratic, more reform-minded in the economic sphere, Medvedev, prevail in some of these policy decisions over Putin and his groups, who are more sort of conservative and more... so the issue is, how do these two leaders get along? The younger guy is Putin's protege. Is he really being controlled by Putin? How much initiative does he have? Because he comes across as, except in foreign policy pronouncements, when it comes to domestic issues, policies, bureaucratic reform, legal reform, he comes across as very, very liberal. So how do these two men get along? How do their two groups, how do they fight with one another? So that is also one of the debates which I follow. And then the Russian humor takes in, which is where I can tell my joke. Well, it's sort of, I mean, the humor, it's very intellectualized, Russian humor. It has a very delectable quality, and it moves with the moving times. Under Stalin, from Stalin to Khrushchev to Brezhnev to Gorbachev to Yeltsin to Putin, the quality of the humor has changed. And it tells everything about the situation. So the recent humor jokes which I hear is how do these two men get along is the big issue, right? So Putin and Medvedev go to a restaurant for a meal. And, Russian language doesn't have an article. It doesn't have the or a, which we have in English. So the waitress asked Putin, what will you have? So he says, I'll have steak. So the waitress asks, how about vegetable? So Putin says, vegetable also will have steak. So then the next question, the next humor is, Putin is asked, will you put the president's portrait in your office? Medvedev is the president, right? And Medved, as you know, in Russian, it means a bear, literally means a bear. So Putin replies, no, I'll have his skin on the floor, my office. So, the jokes, in other words, have taken a full circle, becoming very Stalinist in their flavor and content, although I don't think Putin is Stalin. The jokes have turned full circle. That is all I wanted to say.
Thank you very much. I think that wonderful joke has reminded me that my colleagues and all of you have given up your dinner hour to be with us tonight. So please join me in thanking all of us, and thank you all for coming.